right, so we're here back at the Real Estate Roundtable with IPRG, and today we have Jesse Terry as a guest. He's the Managing Director of Acquisitions at HUBB, New York City. Welcome, Jesse.
Thank you very much for having me, Derek.
100%. Pleasure to have you here.
Pleasure is mine.
Good to see you again. We've done a few transactions over the years and hoping to continue to build on that. How long have you been with HUBB for?
9 years.
9 years, nice. And before we started recording this, I just went into to Google and I put in HUBB and went to the news articles, and there's a number of articles that came up with your recent acquisitions and the Real Deal. You did the Aimco transaction portfolio, 11 buildings for $190 million not too long ago. North 7th Street, $116 million. Union Avenue, $76 million. 31st Street in Astoria, $75 million. The list goes on. So you guys have been doing a number of big transactions. You guys have been very active in the market. These were all 421A deals. I saw you guys did some retail condos recently for reasonably big numbers. A garage, I read. So yeah, I guess we'll just kick it off there. This is some of the stuff you guys have done.
Yeah, we've really been focusing on residential investing in New York City. It's the only place we invest. We have a portfolio of approximately 90 properties. We have done a lot of 421A deals, just focused on new construction product because there's such a broad appeal in today's rental market. But that's not all. The Aimco transaction was 26 walk-ups in the Upper East and Upper West Side. And we have a lot of small buildings as well, so definitely all sizes and focused on investing in all the boroughs in New York City.
Yeah, I was looking at Property Shark, and this could be wrong, but I thought that I saw you guys have a 2-over-1 on Bleecker Street?
Yes, we have a couple buildings on Bleecker Street, and they come in all shapes and sizes.
Two apartments in a store. So that's reasonably small buildings, very big buildings. Based on the stuff that you own, how do you guys view like these smaller buildings versus?
They are certainly a niche investment strategy, and not for the faint of heart, just because of the operational inefficiencies with small buildings. But we have a very substantial portfolio of them in Manhattan. So that gives us some ability to optimize the management of the small building assets. But we are investors in New York City, and there are buildings of all sizes, and we try and evaluate them all and seek the best risk-adjusted returns we can find in the market at that time. So we're steady buyers. In the ups and downs. A lot of the recent activity that you referenced was just the COVID recovery and trying to take advantage of when everyone came back to New York City and follow that trend and buying multifamily.
Got it. So you mentioned a couple times now that you guys are investors in New York City, but you have a lot of capital. You could invest anywhere. There's other companies based in New York that do invest all over the country. Is there any reason why it's focused in New York?
It is a mandate from our capital structure to just invest in New York City, and New York City is incredibly complicated. Yeah. So it takes a very substantial specialization to understand all the different factors, not the least of which is regulation. So it keeps us busy from that perspective. And on the multifamily front, we see 1,000 new deals a year in multifamily in New York City. It's a lot to whet your appetite in terms of the investable universe. So
yeah,
for sure.
1,000 deals in New York City. It's no shortage of amazing real estate. All right, so we spoke a couple days ago, and I think this is a good place to get to this. You mentioned you get 1,000 deals sent to you per year, and you're saying that in Q4 you had a certain amount of offering memorandums that were landing on your desk, and they looked a certain way. In Q1 so far this year, after the turn of the new year, you're getting a different set of offering memorandums on your desk, and they look different. And I think it's how you kind of gauge where the market's at and what's going on with the other people that are potentially considering selling their properties. So can you give us the overview on that real quick?
Yeah, certainly. Q4 was a very interesting quarter because I think it was the first time the market could fully acknowledge the increase in interest rates that occurred over the summer. So everyone was on the same playing field with the cost of debt. And it led to a lot of large deals coming to the market. So we saw 35, $50 million deals, multifamily deals, or greater than $50 million. We normally see 20, so it was almost twice the number of sort of institutional style deals that we saw. And there weren't actually that many small deals, so $15 million or less. Then that changed in the first quarter. We've only seen 2 new large deals, $50 million or more, multifamily. And we are seeing 200 small deals. So, who needs to sell, has changed. The institutions obviously need to sell, probably related to capital structure. And they tried in the fourth quarter. Not a lot of it traded. We normally see half the deal volume go through. In terms of trades, fourth quarter we saw about 10% of the deals actually trade versus what we saw. We'll see what happens with these small owners, but it's a lot of volume. I mean, 200 small deals is a lot.
Oh, yeah. All right, so you said in Q4, you said the institutional owners had to sell.
I don't think you would bring a deal to the market in this environment unless you really want to sell.
I agree with that, yeah.
So, but they may not have had to, but
a lot of them didn't sell, right?
Yep.
So what goes on with these deals? So let's say that it's ideal for them to sell, or they have to sell. There's just some kind of writing on the wall, which maybe you can elaborate on, but then they don't sell. So what is going on with these properties?
It's tough to say, and I think everyone's capital structure is different, but capital structures are definitely driving sales. Many of these are need-driven sales associated with a very tight capital structure. Some of it's related to floating rate debt. Some of it's related to high leverage with near-term loan maturities. It's about 1/3 floating rate debt, probably 2/3 near-term loan maturities. But what is happening with them? We will see. It's really what is going to be the most interesting, I think, facet of the market in the next 12 months. The deals shifting to special servicing, these are all multifamily deals, shifting to special servicing right now is pretty amazing. There's about 20 properties, $500 million worth of product that I know of that's shifted into special servicing. And that's not like that easy to access in terms of information, so there's probably a lot more. And this is a market that's at its peak rents in terms of revenue, the top line, and they're going into special servicing. That's a pretty amazing facet of the market, and I can only expect that will grow as there are more and more loan maturities. So debt is coming into play. Foreclosures are coming into play. It's not something that we've really seen in a long time in terms of the market cycle.
And these are going into special servicing because the debt is maturing, or?
There's floating rate debt is probably the primary cause. There are some big institutional names that had floating rate debt, and floating rate debt costs a lot. No one expected interest rates to increase so rapidly. So when your cost of debt goes from 4% to 10% in a matter of a couple of months, it changes your cash flows very substantially. And a lot of these deals is driving the cash flows negative. So people are coming out of pocket. It changes your view on the asset.
And they're not going to pay down that debt, obviously. You can't.
It's a tough call.
It's a really tough call.
You mean like cash and refi?
I'm sure they're looking to sell before they do that. That's kind of a last-ditch effort, I would assume, right? Paying down. But like you said, everyone is paying down debt right now, but that's a decision that's hard to make, and it's not one that's preferred.
Certainly. The question is, where do interest rates stabilize and where do cap rates stabilize? No one knows right now, but we're seeing a lot of pressure for increasing yields on the long end of the Treasury curve, and that's causing a lot of pain in the real estate world because leverage is such a big part of the game. I think with a lot of the floating rate debt as well, there's a lot of leverage associated with that. You'll get half that leverage today. It's really a remarkable pay down given today's interest rates.
Let's just take a step back, because I just want to make sure we're all on the same page here. When you say these deals are going to special servicing, what does that mean? That means that the lender's no longer servicing the debt, or the borrower is not.
In like a CMBS deal, that means there's a special servicer. So there is now a person that has taken the loan out of whatever securitized loan it is part of, and it has shifted out of this securitized loan, and there's now someone on the other side to actually negotiate what's going to happen next with this loan. It's a very challenging position for a borrower because these special servicers are now receiving asset management fees and fees for all the things they're doing. So they are now heavily incentivized to keep these assets in the special servicing area, which is very profitable for them. And
Paid for by the borrower.
paid for by the borrower, and default interest could be
Are
accruing.
these in default? These loans that go to special
they're not-
servicing?
Not necessarily, but most loans have a debt service coverage ratio that is probably in a technical default.
Technical.
It's not necessarily a monetary default, but there could be a technical default, and the borrower probably wants something. I think we learned from the last cycle, though, that when you're in this position, these lenders are very rarely negotiating anything unless you're putting down a lot of cash.
So these institutional size deals, these big deals, end up in special servicing. Like, what happens from then? It turns into like I've been reading about foreclosures or people like giving the keys back. Like, what just happens with like how do these deals play out? I mean, I guess either you get out of special servicing, however that happens.
Yep.
Right.
So these special servicers, I was looking at a deal in Hell's Kitchen that was foreclosed on by the special servicer.
Okay.
And I think it was associated with maturity default, although I can't recall. And at some point, they're going to unload it, But in the meantime, they're collecting a lot of fees by keeping that.
Special servicer unloads it through foreclosure.
Well, they foreclosed it.
Okay.
Now they
Okay.
own the keys.
Got it.
They have it, the asset on behalf of their bondholders, and they will make a decision at some point in time as to whether it's advisable to sell. It's usually related to whatever value they would achieve on the market, and if that value, matches whatever accrued interest, whatever incentives that they have on it.
Okay.
Like Stuytown was definitely the best case of that. I mean,
Sure.
the special servicer had that asset for several years when Tishman
got it.
defaulted on that.
Okay.
So, but we'll see. I mean, that's going to be a big part of the next 12, 18 months is what the lenders do.
So staying on these institutional owners that brought their properties to market in Q4, they didn't sell, they didn't go to special servicing. Like, what's going on with these properties? They're just continuing to manage them, or
Yeah, and they're incentivized to manage them because of the fees. Those deals will be in purgatory. Now, there's a lot of different capital structures, and this is probably one of the most interesting facets of fourth quarter in any deal that's coming out. Now we see, we hear, we find out what the capital structure was, and on the same side, I'm seeing more and more mezz lenders taking control of assets because they've got to protect their interests or they'll get foreclosed out. So we've seen some mezz sales at a discount, which is indicative of how highly leveraged some of these assets are. Leverage is a huge deal because a lot of these people borrowed when interest rates were 4%, and now they're 6%. You get so much less debt when the interest rate is that high.
yeah. All right. So moving into what you're seeing in the market now, you're seeing no large institutional deals because I guess those owners just don't like where the pricing is, and they say they're not going to sell. But you're seeing a lot of the smaller owners starting to come to market. So I don't know. What do you think is going on there?
I think it's where we are in the investment cycle related to debt maturities. So, a lot of our peak investment sales were in 2015, 16, 17. That 7-year, 10-year debt is near maturity. And the smaller owners are bringing these deals to market because they are probably nervous that they will have to write a big check to de-lever those assets. So the cash-in refinance is I think, motivating factor for these smaller owners that may not be as well capitalized, or these smaller owners that are maybe impacted by the changes in the investment market in other places. So they are getting hit all around right now in terms of their portfolios and their balance sheets, and they may want to may want to decrease their real estate position.
Do you think a lot of these developers that are just finished construction and obviously they're looking to do a capital event, interest rates being so high, do you think there's going to be a lot of stuff going to market because they can't really get the refinance they wanted?
I would definitely think so.
Yeah.
I think people's expectations for values when they probably went and started the construction project or initially did their pro formas is much different now than their expectation. If you're looking at a refinance with 6% debt, I mean you're just going to get so little money back compared to your construction loan, which was probably pretty aggressive. So, whatever your duration is on the investment is really critical right now. So we have seen some refinance those deals with permanent debt. I wish I could say for our investment that we're seeing more dispositions in that world, but we're definitely not seeing a lot. We're seeing people recommit to their assets right now.
Yeah, it's a brand new building. I mean, great to pick it up, but they're not going to want to offload that either.
In a peak residential market, with rents so high, it's probably tough.
Really tough.
So we talked about this a little before. Maybe we already touched on it here, but like what do you make of this? We have a peak rents. They've never been higher. And we also have all these properties that can't service the debt. And I guess we spoke before we started recording this, but we talked about we're realizing there's all this floating rate debt in the market. And I know you had your theory on like why that is and why all these people have this floating rate debt. I think you were a little surprised to see how many people have this. But can we just talk about this for a second? All this floating rate debt that's going on out there?
Yeah, I mean, it's...
And the challenges people are having given the great rental market?
Certainly. It's about duration and it's about what your investment strategy is. We are long-term owners. We've never sold an asset. We put long-term debt on all of our buildings. There are a lot of people that deploy a value-add strategy, and they do shorter-term debt or they do floating rate debt to cover themselves while they may be renovating units or executing on a value-add strategy. And they may have waited too long to sell. The problem is that our peak rents in the city were July of last summer, and then the following month, just when we topped out, interest rates started ballooning. So these people never really had the chance to get out of their value-add strategy. So they are sometimes exposed to this. I don't know. It's a tough situation, and a lot of I think institutions just saw and thought that interest rates would remain low for an extended period of time. If they thought they were going to see a rise, they would maybe change their debt structure. They had caps on the floating rate debt. No one would have ever predicted that interest rates would go up so rapidly. Everyone, I think, had a presumption that interest rates would go up, but never so rapidly as they just did.
Yeah. All right, cool. Do you guys have anything to add real quick? Otherwise, I guess I have like three main categories.
I heard from a few people that they thought interest rates were they were very surprised that they shot up so rapidly, but they also thought it was going to be a short-term window. I talked to a handful of buyers that predicted, especially in 2023, that they would come back down. We saw a glimpse of that, I think, in January, but then, boom, it's up again. So that's interesting too. I mean, now people are freaking out a little bit. I think
higher interest rates creates so many challenges. What's just amazing. I mean, I know we've talked about this, but like, it's not big swings in the interest rates. It's really not. Like,
but for big deals, it is.
But it has such an impact on value and yield and all that.
Before you say that it's not big swings, in the past month, it's been a 50 basis point swing in the interest rate. That is a lot.
Yes.
Yeah.
I mean, it is on a percentage of what the current interest rate is, but I don't feel like it's a lot just in terms of like gross numbers.
Yeah,
like
but we talked earlier, Jesse, about
6.
what happens with a half a point, right?
Yeah.
You said half a point, you could be at your debt very quickly.
Yeah, no,
It's true.
I was trying to convey my experience in buying new construction product, and I would talk to owners, new construction, the developer just finished, and they'd be looking for a 4.5 cap, and on some of that stuff, the market was like 5.25, just because of interest rates and other aspects of the market. And at 5.25, these developers would be at their basis, and anything higher than that, they begin to get very close to their debt levels. So, it is not much of a swing that causes, a lot of damages or changes to your capital structure.
It's surprising hearing that. Like, that's a low cap rate to be at your basis. Like, those numbers are tight. Like, I remember we sold obviously a ton of development sites to Brooklyn guys, and obviously in previous years it was a little bit different. But these guys are trying to build a 7% returns, right? 6%.
7% was always
that was the goal, right? And maybe some 6, but to build
yield on cost,
to a 5.25, 5.5, there isn't room there. You need to sell like eye-watering amounts to make money.
People thought the market rents would grow a lot more, and so that's why it got so thin to the basis. So the 3 or 4 years between the plans and the actual completion of construction, the market did not really grow because there was so much supply that came online, so many competing buildings that came online at once, just because of the nature of the way the 421A actually ended last time around, which is interesting.
Getting off topic a little bit, where do you see rents going from here? Obviously, we had a high point last summer. I think rents are still very high, but I do feel a dip in rents now.
There's definitely a dip, and we use a lot of different brokerage firms to lease our multifamily. So I have a pretty good flavor for what the various opinions are on it. There's definitely a dip. Some markets have less of a dip than others. I mean, it depends on who your renter is, and affordability is obviously a huge issue. So, like, from my perspective, like the Upper East Side, the Upper West Side, very stable markets. Not really that much of a dip. Probably relatively flat in terms of rents from the peak in July till today. Markets like the Lower East Side or the East Village, not so much Williamsburg, which you might, put into those areas. Those areas have dropped 5-10% since the peak of the market. And generally people are like, oh, it's the off-season, rents go down.
Yeah.
They don't go down this much. If you look at the pre-COVID sort of off-season data, it's flat. It's not down.
Yeah.
That's the difference. Like, rents are declining in some of the neighborhoods, so that is challenging. I believe what's actually still happening is our renter demand is still stabilizing. So, like, when people came back from COVID, we had a lot of money in our bank accounts because we lived at home. We saved a lot of money. Our stock portfolios are great. I just got this, raise at my investment banking job.
Yeah.
I'm going to be house hungry. I'm going to, take and consume more square footage of housing in New York City than I would have pre-COVID, because I'm aggressive. So if I, was going to take a 1-bedroom, maybe I'll take a 2-bedroom and use it as a home office. I'm just doing better financially than I was pre-COVID. Or if I was in a studio, I would take a 1-bedroom. Or, I may not necessarily have roommates anymore. So you're just consuming naturally more square footage. The consumer demand for housing is shifting, and you see the contraction. You saw it a lot. People are now consuming less square footage. If you look at the January data, the studios were off the charts, like in terms of performing compared to 1-bedrooms or 2-bedrooms or 3-bedrooms. It's pretty amazing. Is that indicative of what it was pre-COVID? Because now people, studios are in vogue, like, because you're not taking that 1-bedroom anymore. Like, we just don't know where the market stabilizes. The only thing I say when we look at our low vacancy rates, it's probably not because of our New York City population. We still don't know if we are back to pre-COVID population in New York City. That data has not been revealed by anyone as to where our 2022 population is. So the vacancy rate's still very low. Why is that? I think it's probably just because we're consuming more residential space.
What I also think has contributed to this, and I'm selling a lot in the East and West Village, is tenants now, renters, they're paying attention to the condition of the unit. So you're saying they might want to rent a smaller 1-bed or a studio. I sold a package down on Avenue A, Tompkins Square Park, 5 buildings, 80% studios. We were pushing rents over $3,200 by the time we got into contract. They were not in good condition. They needed work. So the question is, how much more could you carry those units forward? The buyer seems to think, maybe I can renovate and even push rents further. But when you look at Greenwich Village, it's a completely different type of renter that's going into these units. It's like, college graduates or people coming from the West Coast, living here in these walk-ups versus, wealthier families, doctors, lawyers that want to have their families living on the West Side. So I think it plays into the condition, the size of the unit, and what they're willing to pay there.
Yeah, the unit type is an amazing, factor in housing demand. And contrary to what I was just saying about population, I think one of the more interesting facets is the foreign renter. Like really the strength of New York City that isn't discussed enough is how many foreign people are here. That's, true of tourists, but it's also true of renters. And there are just major neighborhoods that get foreign renters, a large percentage of foreign renters. And it's a huge part of our demand. So as our global economy, stabilizes and, people start coming for business and having pied à terres and, what have you, I mean, it's a huge future driver and wouldn't necessarily be caught up in our population growth, for instance. So that is one part of the rent factor that I probably, should
What
mention.
kind of unit type do you have the most interest in? Like if someone sends you like an offering memorandum and it's got like all 3 beds and something versus all studios, does like one like appeal to you more than another?
I would say it used to, but my learning experience in COVID was that you have to be extremely astute to figure out which is going to zig when others are zagging. Like when I was looking at the COVID data and the recovery, doorman buildings, 2 bedrooms led the way. You're like, wow, you should buy doorman buildings. Then they got to an affordability point where all of a sudden walk-ups were the leader in the recovery. Now maybe doorman buildings were 10% over pre-COVID levels, but then walk-ups were 15% over pre-COVID. And then it just kept changing, whether it was 2 bedrooms or 1 bedrooms. And when you looked at the recovery versus pre-COVID, they all changed. And it was very dynamic. And I couldn't say. Now, what I will say is rent per square foot is such an interesting indicator because it determines what you can pay for the building. Our expenses, particularly for like a tax class 2 building, it's very formulaic in the city. It's like, 20% of your revenues are operating expenses, 30% of your revenues are real estate taxes. So the factor when you capitalize things is what is the rent per square foot? So like you can really quickly get to, okay, if I can achieve $100 a square foot in rent, the buyer, not necessarily in today's environment, but maybe the summer's environment, could probably pay $800 a square foot for that asset. If you just back into 50% of your rent per square foot, going out to the various operating expenses. So what can you buy? Well, it's a combination of like affordability. You can't have too high because you're never going to be able to lease the stuff. It'll take too long. But there's a sweet spot in terms of what price you're going to pay and will actually cause a building to trade, because you need to have a buyer and a seller. So if I told you your asset's worth $500 a square foot because you're getting $50 a square foot, that building's probably not going to trade because that seller is not going to recognize that his comp that he's looking at to get $800 a square foot achieves $100 a square foot in rent, if that makes sense.
Yeah.
So you need a certain price point just to cause the building to trade. So that person that has the $500 square foot building is never going to acknowledge that his layouts are dysfunctional or not optimized, so they achieve a much lower rent per square foot. It's going to be one of the more interesting facets of the office conversion, because an office conversion is never going to obtain a high rent per square foot because you can't optimize them. You can't optimize them for modern living. You're always going to have inefficient spaces, inefficient lighting. So if you backed into what the value of that when you're renting it out, it's going to be much less valuable than new construction. And that's going to really cause problems, I think, for the conversion.
Got it.
That's a good point, especially with the office conversion. I mean, I haven't even thought about that, but it's true. I mean, look at our office. It's weird. The windows are all in weird places.
Well,
You couldn't.
this is a newish building too. I
yeah.
guess it's 1980s.
But yeah, think about it though, especially in the industrial stuff like
Look at like
this.
some of the stuff out here though. Like imagine the conversions.
Think-
of some of these.
think
Look
about,
at
like,
that
the-
one there.
Especially the industrial stuff in like Soho and those areas. Like the windows are in the front and they're in the back.
The tiny windows.
I live
and all the bricks.
I live in Tribeca, and it's a 2,000 square foot apartment, but there's windows in the front. It's a loft, so there's windows in the front, windows in the back. You would like more light. It is awkward, but I guess because the location, they get a big price per foot, but it's interesting to think about that. It's not right.
It's interesting that you bring that up. We're evaluating a deal right now just below Canal Street.
Yeah.
It's an 8-story, 40,000 square foot light manufacturing building. It's got nice frontage, but it's on, Cortlandt Alley right below Canal.
Yeah.
Off Walker.
Yep.
So it's not really a
Walker's
busy.
too, yeah.
It's technically Tribeca. It's like East Tribeca. It's not really a location where you're seeing a lot of
Yeah.
people walk through. Not a lot of foot traffic, but it's interesting. We're trying to evaluate what you do with this building. And it's a vacant warehouse, light manufacturing. Taxes are high. It's tax class 4. And the guy wants to sell it. It's got 2 freight elevators. And it doesn't really have retail presence. So the question is, what do you do here? Do you go office? Do you go for a variance and go for a resi conversion? What would you do in that type of situation if you saw a deal like that?
Hope that I don't own that asset, but I mean,
Not for you.
Office is highest and best use. I
Yeah,
mean, there's no
probably.
doubt, and that's an issue. I mean, you're really looking and waiting for someone to take over that as a boutique office, architect space or something like that. Those are extremely difficult resi conversions. I don't even know if it's allowed by zoning.
Mm-hmm.
The variance is certainly very difficult to get. If it isn't, you'll lose so much square footage on light and air conversion. So it's really difficult.
That's why I think you have to look at this as like a 300 a foot deal, maybe self-storage, maybe it's a hospitality play, something kind of, off the path of what's normal down there.
Yeah, that's why we stick to multifamily. It's much simpler to get
It's a good way to go.
your head around. Yeah.
So no office or anything like that for you guys.
No. The other asset class that we evaluate is retail, and
Okay.
it's comes with all multifamily anyway, particularly in Manhattan on the avenues.
For sure.
So we always get retail exposure from that, but retail is something we look at. We haven't really been able to capitalize much on the retail recovery in terms of COVID, just a couple of small spaces, but we have absorbed a lot of retail just by buying multifamily with retail on the ground.
Yeah.
Will you buy isolated retail, like commercial condos or multi-unit?
Absolutely. It's
Okay.
just a very difficult asset class to figure out right now.
Yeah.
And if you think it's difficult to figure out what financing cost is for multifamily, try applying that to retail. So it's a really difficult conversation with whoever wants to sell that retail.
Why? What are the challenges there?
So if interest rates are 6% in multifamily, retail is probably 6.5%, 7%. People can't fathom those kind of cap rates to have
Got it.
positive leverage in retail. If you had any debt on your retail position, you'd be underwater. The only pure retail asset that we were able to buy.
Values are down a lot in that category on retail.
Well, just the cap rate,
Got it.
the substantial increase.
Okay.
I mean, we could talk about where the retail market is in terms of the recovery, and it's obviously very different because of the office recovery. The fact that so many fewer people are coming every day, so the retail is very dynamic landscape. But the only retail asset we were able to buy during COVID was actually a single asset where the owner had inherited the building, lost the tenant that was paying for his retirement, and had to liquidate the asset. So he had no basis really, and he was the only one that we were actually able to transact with. But retail is a very difficult opportunity right now.
And going back to the multifamily stuff,
Yeah.
Would you guys do value add? Are you doing construction and pulling permits, or are you just looking for finished product?
No, we absolutely look at value add opportunities.
Okay.
We absolutely execute value add opportunities, and we have a lot in various stages in our portfolio. Value add is a very tough game right now because of the city's tax strategy and the fact that the city will take out 30% of whatever you increase the revenues with that investment strategy. And we are in a very substantial inflationary environment, which makes modeling out a value add strategy very difficult. When I started at HUBB, you could effectuate probably 15, 20% return on investment from renovating an apartment or something. But with the city's tax strategy and the increase in labor costs and material costs, those margins on a lot of that activity are 5% today. You know, it's really much thinner in terms of the return on doing value add activity today. So it's a very difficult strategy to execute in many regards.
When I think about you guys, obviously a lot of your big trades are big new construction buildings with 421A, so there isn't value add to that, I expect. So, when you say value add, what do you look?
Value add to 421A?
Very rarely in the boroughs, because those are relatively recent construction, 5 to 10 years old. The 421A buildings in Manhattan are from a previous cycle, so they are like 15 years old, and they would have a value-add strategy just because a lot of those owners didn't really put money in because they were rent-stabilized properties.
It's interesting.
So when you do, your value add is like a simple like alt 2, like you're renovating an existing apartment. You're not adding square footage. You're not reconfiguring.
We have 121 Chambers that goes to the REIT, and that's a gut rehab right now.
Really?
So we do
all a 421A building?
No, it's an old manufacturing facility.
Okay.
We will do all different types of value-add strategies.
Interesting.
It's just whatever it's an investment decision, and right now it's not the greatest time to have that investment thesis because the returns have thinned so much on that business activity, and when we could talk about it, but like the city is not helping in that cause, and the timeline that it takes to do those projects has increased a lot, and that costs money too. Yeah,
especially with interest rates being where they are, I feel like you should let someone, and construction costs, but you should let someone else do the work, and especially if you're buying all cash, like you mentioned, buying all cash, there could be some really good yield plays. And why take on the burden of construction right now if you can have someone else do it? That's my thought.
Mm-hmm. So I'd like to talk about 421A for a minute. Seems like most of the stuff you guys bought recently was 421A deals. You were clearly one of the most active buyers of 421A properties. We've attempted to sell a lot of 421A buildings over the years, and a lot of them we just there's just a pricing gap between what the seller needed and versus where the market was. Also, for a period of time there, I think a lot of buyers didn't understand the taxes on them or the tax increase exposure and how to underwrite the future tax amount. But you guys obviously did a great job with that and got a number of deals closed. So I guess, what is it about the 421A program? Like, why do you guys like it so much? Like, why was that such an area that you guys focused on?
It certainly was not our primary focus, but we do find it to be compelling to buy a new building that's developed for modern living. If I buy a 1920s building in Manhattan, there's a lot of heartache behind those walls, and there's a lot of risk associated with that. A new construction, it's just set up efficiently for modern living, and we appreciate that. Capital expenditures really hurt a lot of deals over the years, and there's a lot more of those associated with the city's very old housing stock. So much of our city buildings they're very old, and they're 100 years plus, and there's a lot of expense related to that. So there is a simplicity of that investment strategy of new construction.
Got it. But these buildings still have a rent stabilized component to them. They have a massive tax increase exposure at some point down the road, right? Because aren't the tax on these going to be, call it 30%, and currently they're 1 to 5%?
Certainly, yes, and that is.
How do you factor all that stuff in?
Well, you try and make predictions about what's going to happen at the end of that 421A, but it's just an interesting facet. If you look at Williamsburg, Williamsburg is so much new construction. The change in zoning and converting basically an industrial space landscape to residential, really amazing. So the 421A supported a lot of that, and you have all these different vintage buildings. Mm-hmm. So, for instance, the 2010 vintage 421A building in Williamsburg, how far below market rents are those buildings? They've probably been increased at 2% annually for at least the de Blasio.
That would be a 100% rent stabilized asset?
Yeah, like the 15-year 421A,
okay.
Or whatever.
Yeah.
So I'm at 25 years. But so there's a lot of embedded upside in the rents because these buildings have had rent rolls that have increased at 2% for basically the de Blasio era. So there's upside just there. Then there's whatever future growth you expect to have. And, we find they make financial sense based on those characteristics. The new program that is now, I guess, deceased, the Affordable New York program, that had access to free market, units. So those rents you can generally align with the end of the 421A, which is 35 years out. So you have a lot of time to make up for those taxes.
35 years, the 35-year abatement is way more compelling in terms of the tax increase exposure, right? Like you have a long time to let that thing go before the full tax bill starts to come on.
Certainly.
But then I guess it's a long time also you're dealing with the program.
Yeah.
I don't know how complicated that is, but people have mentioned that it can be, I don't know, it mentioned that it can be, I guess, a lot to deal with all the nuances of managing the program over the long term. Do you see that at all?
I don't think it's that difficult. I think the expectation for the program with the affordable leasing was probably a little incorrect. The concept of leasing out units to 130% of the area median income, I think a lot of people had some challenges with that because that renter probably doesn't want to go into the system. So, like in Manhattan, the income restrictions are much lower. So I think it works better than, for instance, the Brooklyn version of it.
Okay.
But I think that's probably the greatest challenge was leasing those affordable units.
That's the 30%
yeah,
on that program?
Yeah, and leasing them at like 130% of area median incomes. That's a challenge.
Got it. All right, cool. Well, congrats on all those deals. That was really awesome to see, and excited that you're still are into those. So you mentioned that you guys never sell. You've never sold. That's what you said. So what's like the business plan with these properties? Like just buy and hold. What's the play with all this stuff?
Long-term yield for our investor.
Okay.
Just to meet the future capital requirements of our investor.
So long-term yield. That means are you looking at like the net cash flow after debt service and all that, and providing like cash on cash distributions and stuff?
Yep.
So that's how you're underwriting all the deals for positive.
IRR is very difficult to get in New York City. You have to time things extremely well. So, for instance, we've always focused on just the long-term stabilized yield of these assets and making our investment decisions based on that. We look at, for instance, IRR to make sure we're not making any long-term mistakes, if you will, but it's definitely more focused on long-term yield. And IRR is more like, how's the price per square foot or any other metric that you would make or utilize to keep yourself in check.
All right, you mentioned a number of times over the years operational efficiencies, how that plays in and how that's so important to you and into your calculations, I guess, on your yield and return on investment. Any opinion on just the operation side of these?
Of the 421As or the
I guess
smaller
the
buildings?
The portfolio in general.
Yeah, I mean, we have a lot of comments on it. The city's changed a lot. The regulatory environment's changed a lot. And the expenses associated with all those things have increased substantially. I mean, if you just looked at minimum wage or even insurance costs of these buildings, particularly the smaller buildings, they've far surpassed, inflation. I mean, it's remarkable at how rapidly wages, increased. And how much more time is required to manage these buildings, particularly in this regulatory environment. So the yields in New York City real estate aren't that high. So you really have to focus on operational efficiencies, particularly when you own buildings for the long term. And, coming up with optimal staffing and servicing of these buildings is a real focus. And it takes a lot of time and attention to optimize that. It's incredibly important. And like, for instance, we have a lot of our smaller buildings in Manhattan, which a lot of these buildings are very close to each other in the same neighborhood. But Manhattan also has a very flexible transportation system. So you can operate these, get people to these buildings very quickly and efficiently. In scattered neighborhoods in like Brooklyn, where it's very difficult to get from one neighborhood to the next, it's a lot more challenging. And the operational inefficiencies impact pricing.
So for you to buy, obviously you've jumped around in different markets. For you to buy, and I remember you bought that big deal in like LIC or Astoria. And obviously you don't have a ton there, so that was a decision, but that was a huge deal. So
Yeah, and that property supported full-time on-site staff.
sure.
And
114 units.
yeah, it's a big deal.
So that helps a lot in the operational
And
efficiency.
then you jumped into Williamsburg and you bought that Union deal. That was still a relatively big deal. So how many units? 70 units, right?
Union's 130.
130. Wow. Okay.
Yeah, I mean, and those buildings have on-site supers. It's much easier than getting a super to scattered neighborhoods to service, to take out the trash, to meet the tenant needs, to shovel snow.
Yeah.
So there are a lot of operational efficiencies with the larger buildings. We evaluate all deal types, and we thought the yields on the smaller deals really decreased over the past couple of years, while the operational efficiencies for the larger deals helped achieve higher returns. So that was just an investment decision.
Are you guys an institutional investor? Would you consider?
Yes, absolutely.
Okay, got it. So like in the institutional world, you're competing against some big public companies, REITs,
Certainly.
that kind of stuff. How do you what are your competitive advantages? Like, how do you guys end up winning the deals? Or just I don't know. What do you guys do that's your competitive advantages? And just a quick side note on this. I went to your website. It looks like you're incredibly tenant oriented, focused on giving them great living experiences. But what is it about you guys that
I mean, on the deal side, it's just being extremely flexible.
Okay.
Like that $190 million Aimco deal, we purchased all cash and closed in 2 weeks. That meant a lot to the seller at that time.
do you mind me asking how you get that much money to close in 2 weeks?
We have a large institutional capital source he's supporting us, and it's a single.
Guys got a lot of money.
That's a advantage. That's a competitive advantage. It's a single capital source. We don't invest with any other money. We have no partners. We've never partnered with
No JVs
anyone.
or anything?
No. So we have no partners. So that is a competitive advantage, but it's not as much of a competitive advantage as you would think. That was maybe a competitive advantage during COVID. It's not as helpful and doesn't win us that many deals. I think the way we win deals is actually just endurance. I mean, it's just focusing on everything that's going on in the market, looking at all the opportunities, understanding all the opportunities compared to each other, and going after whatever we think provide the best risk-adjusted returns at those time, and just focus on those deals. We're looking at a lot of deals. We put a lot of resource to tracking deals. We've been tracking, all the sales for 10 years now. I mean, we have a wealth of knowledge on the history of, New York City real estate, and that helps us. And that we're repricing everything so frequently and trying to figure out where the inefficiencies are, and where we can identify new opportunities going forward.
And I mean, they have you. I mean, you're doing a great job.
I was just gonna say that, yeah.
Exactly. Talking through this, and having the conversations we've had, and on top of that, you reached out to us, and you're like, we need to get together. We need to know what's going on in the market, whether it's the big deals or the small deals. So you and your team are doing a really good job. And
I would agree with that. Every broker, whether they sell big deals, small deals, medium deals, they know who Jesse Terry is, and they know what you guys buy, and that's something a lot of these big institutional buyers can't say. Everyone
That's for
knows
sure.
who you are. You're visible. I've seen you a million times. It's good. I think it helps a lot.
Thank you very
you're
much.
approachable, you're in touch with the brokers.
Yep.
Well, I appreciate that very much, and
Yeah.
it's great to be able
You
to
can
work
take
with
a
you
junior
two.
guy in our office right now, and you can say, "Who's Jesse Terry and what does he buy?" And he would know who you are and what you
Sure.
buy. So, and most people can't do that. So that's good.
And the tracking and data that you guys have, and just the way you talk about it, the metrics that you guys pay attention to in your office, it's very interesting.
Yeah, I mean, it's the point of the whole business plan and the specialization, why we only invest in New York City, because it's tough to learn a new market or a new opportunity in other areas every time.
Yeah, and you mentioned a lot of your stuff's in house, but brokerage stuff is not, right? So you're always going to third parties for leasing and stuff like that. Management's definitely obviously in house,
Yes.
right? Yeah. And that, what are your capabilities there? What are your advantages?
In today's regulatory environment,
Yeah.
we can't leave anything to chance
Yep.
with outside companies on the operations. So that is definitely internal. But just as you're saying, staying in touch with the market and what's going on in the market, we utilize a lot of different brokers to help us on the retail and residential front. and we try and use that as a resource and competitive advantage with the market information that they have. So that is very important to us, those relationships.
For sure.
All right, great. I just want to. I mean, we have Zach here, and before you came, you said you want to talk about Brooklyn or the boroughs and Manhattan. But is there anything that like any unique changes in the Manhattan marketplace, or just like what like I don't know. I guess where I want to take this conversation from here is I wanted to start getting into like the broader market opportunities, the market challenges. Maybe we could talk like location specific or not, but like what's going on in Manhattan in terms of like I don't know, just like what are we seeing lately? And how does that apply to Jesse and what they're doing?
So I really think it comes down to what bucket of owner we're talking about, right? So we talk about institutional, then you've got, your professionals, your syndicator groups, and then you've got private client, those that bought buildings pennies on the dollar 30, 40 years ago. And now, 10 years ago, I was talking to one owner. Now I'm talking to 8 family members who all have a share and a distribution, and it's just a mess, and they can't seem to come to terms with value. They're typically low levered. They don't really have any debt. In many cases, they'll take on debt if they do an exchange. So I spend a lot of my time, and I've been in the business 13 years, I spend a lot of my time focused on the smaller, middle market, family office. And I think a lot of those people are starting to come to terms with, it's been a really hard 3-year period right now, since the tenant protection, and then we talked about everything that's happened, the pandemic and the interest rates, and I think a lot of these owners are just completely worn out, and it's really tough to time the market. And like you said, you're looking at inefficiencies and economies and figuring out, can I time this perfectly for my future? A lot of people that aren't in the real estate business that happen to own real estate, they just don't have that foresight. They can't do that. So it's up to us as brokers to have those conversations with them. And a lot of those people I think are going to be selling this year. It's been a slow start coming out of the gates. If you look at, south of 23rd Street, I could count on one hand how many buildings have sold under 20 million. There's nothing trading right now. It's either tied up in contract or people want, they're shooting for the moon to try and get a number that's just not possible. So I think those owners are going to start to sell. And we're spending a lot of time just educating them on the market, helping them make sense of, how we price out these deals, as opposed to, syndicators. They have a strategy. They're trying to make their acquisition fee. They have an in and out, and they sort of understand the market. They're in it every day. A lot of these owners just aren't in the market. They're not in the market. So they really need hand-holding, and they're going to sell. I'm talking about smaller, sub 20 unit, even 10 units that have a 2A, 2B component to it. So I think a lot of those people are going to start to sell. We're having those conversations.
Yeah.
But
That's
it's all
why
about
I'm
price
here
discovery.
today.
I know, absolutely.
Well
Absolutely.
said. Well said.
Which is what Jesse was saying at the beginning, the top of the conversation is just all these small deals he's starting to see. The OMs are starting to flood the market for these smaller properties.
Yeah, and honestly could be just as simple as the debt maturity cycle as to where we are. When did these people put debt on? And now that they're maturing, it's just a much different picture from 2015, 16, 17 when they put on the debt initially or when they initially bought it. So that is the opportunity for you as brokers and hopefully me as a buyer to provide them a disposition plan, I guess, to try and acquire those types of properties. But the people with the smaller balance sheets and the people that may have been more impacted by the broader economic volatility, like there's a chance that they have a real need to sell, and hopefully that leads to increased trading.
Yeah, it's tough to manage stabilized units. It's really, and every building has a component to it.
Yeah, and I mean the rent stabilized buildings, like pure rent stabilized. Let's think of like Northern Manhattan. That stuff is a real challenge. What I learned about that stuff during COVID was how correlated it is to interest rates. Like you were just seeing that stuff when interest rates came down. Those rent stabilized properties were trading for like 4 caps when interest rates were 3%. Then they came back up, and the yields just came back up.
It all changed when the value add angle
And
was
it
eliminated.
Well, certainly, and that's a real question for long-term cap rates in New York City. But those rent stabilized properties in Northern Manhattan, for instance, are in real trouble given today's high interest rates, and we know that leads to higher cap rates on those properties because they don't have the growth opportunity. But a highly inflationary environment also really difficult to figure out when your revenue stream is fixed and your expenses, particularly real estate taxes, are increasing, rapidly.
And the other expenses, the insurance,
And
the water, the fuel.
certainly.
We're seeing a lot of those trades too, especially in you bring up Upper Manhattan. I mean, we're seeing trades in those markets where it's unbelievable the amounts that people are selling for. I mean, millions of dollars less than what they bought these buildings in 15, 16, 17. It's crazy.
Yeah, it is definitely crazy because the return on investment, unfortunately, to look at it like this, was so high of deregulation, and particularly in northern Manhattan. So people are able to justify very low cap rates, and they had the double whammy of basically a new tax policy that really hurt northern Manhattan, and then the deregulation or the HSTPA, excuse me. Just really.
And now the
crushed
interest
us.
rates.
And
So
now,
they can't
and
even
now
sell
the
out.
interest rate. And the banks are going to own a lot of those buildings. I mean, basically anyone I think that purchased 2015 or later.
It can't. It literally, what you just described, it cannot get worse for that person.
No,
It can't.
Wasn't there some leniency though? I mean, for an extension, like a 12-month or an 18-month.
the
Well, for
lenders?
lenders,
Yeah, with the lenders. Is that
Case by-
still?
it's case by case?
It's case by case.
I think so.
and the amount of money they're to have to if their loan's coming due, the amount of money they're gonna have to pay down to keep the loan alive. I mean, they're
Those
selling.
will never cover on debt.
They'll
service
never
obligation
cover.
at this point.
Will never cover, and you can see it. Some of these the biggest delta in trades from what they bought the building for, what they're selling now, the biggest delta is in those properties. I mean, it's crazy.
It's just really it really saddens me that, like, obviously on an economic standpoint, like, I feel for the owners and investors, but for the tenants, like, there's no money that's going to go into these buildings. They're going to fall into such disrepair.
No doubt.
It's just not fair to the tenants. Like, I think the tenants in many cases would rather have like some sort of program that incentivized owners to do maintain the properties. Obviously, they don't want to be harassed and like that kind of stuff, but they want to live in buildings. I mean, these buildings are so old to begin with. I mean, you say like what's behind the walls, like there's a lot of issues there.
Yeah.
And everything costs so much.
That's why those who can afford it are flocking to better neighborhoods with better quality housing. They're leaving the walk-up model, the tenant.
Yeah, well, I
building.
mean, just on the tenant side, like that's another story altogether. I mean, what's happening in the free market where just the rents have been going up so much. That's also just because there's not enough supply and there's no ability to turn over these units and all the vacancies. It just
And now
it
420A
really has
is-
a lot of consequences
Yeah.
across the board.
No one wants to build right now either because of 420A. So now it's either going to be more.
All these policies like that they thought were doing good for the tenants, I feel like have had a lot of negative effects. Like, well, what about the free market renter? The couple that's 30 years old that lives in Manhattan and what their rent? What about them?
No doubt. I mean,
Totally, yeah.
it's affordability is
Yeah.
a big part of this conversation, and the rise in rents. A big part of that was the strength of employment and how much incomes actually increased during that same time period, which is that sort of concept of the people were able to consume more real estate and spend more on housing. So it was just the natural evolution of incomes.
You think that money is drying up a little bit now?
Absolutely, I think.
Why? Layoffs?
Well, layoffs, I think, more impact confidence of people and how much they're willing to spend on housing. So I think layoffs are part of the picture. But your balance sheet, your personal balance sheet, may be another part of the picture. How much stocks have come down over the past year. Incomes haven't necessarily come down. I will say I am extremely concerned about the active discussion on how strong our employment market is when it appears that we're just losing high-paying tech jobs, losing banking jobs, and replacing it with service industry jobs. Even though the unemployment rate's so low, I don't think it's great for our economy that we're backfilling the loss of jobs with new jobs in the service industry.
You're saying across the country or
In New York
City?
as well,
Yeah.
yeah. I mean, New York's unemployment rate is not as strong as across the country, but we certainly know that every restaurant in New York City needs employees, and a lot of the strength of the unemployment market, or the employment market that we do have, is from those jobs and the need for hiring in those industries.
You're right.
I feel like just having this conversation, Jesse, I feel like there's all these metrics and economic factors micro and macro local and across the country that you track. I don't know if you have this in mind, but are there specific like indicators that you're like constantly reviewing and looking at? Like, is it employment data or is it the treasuries or like, I don't know. Like, where do you get the makeup to give you the picture of like why we should do what we're doing for your investors?
Well, that's an excellent question. A lot of it comes from just talking to people and having these types of conversations that we're having and discussing. In terms of my own personal education, I try and read a lot.
Yeah.
I certainly follow treasuries, very closely if you mentioned that. But treasuries is just crazy because it's like in our office for the first time people are actually discussing investing in treasuries. It was one thing we were discussing treasuries to just finance deals, but like that's a real investable universe right now, which is very interesting. Employment is the most important thing to me. I mean, what is going on with jobs in this city is so important. I would like to be able to tell you I can follow population, and there's so much noise in what's going on there, but we still, in all of this time, have not heard or discussed how many people came back to New York City in the last year.
Who knows?
Like, we don't know if we have more or less people than pre-COVID. And if we have fewer people than pre-COVID, we don't have the same housing needs, going forward. If our city is actually shrinking as opposed to expanding, we're talking about this housing shortage, and I know it's an affordability question as well, but that's what I would most like to study, but I don't have any answers for you.
What do you think? Do you think we're shrinking? You think we're expanding?
I cannot imagine that we have more people than we did pre-COVID.
Me either.
I just don't find that possible given what we see in the streets and on the subway. I personally, for that kind of indicator, really treasure or value the subway data. And the subway data is still so far behind pre-COVID levels. It's at like 65% right now. I will feel a lot better about our population when we're using our public transportation again, and that's much closer. The office thing is obviously a great concern for our businesses in New York City, which trickles down to a lot of different places.
So if our city is shrinking, why are the rents up so much? It's just all.
I think that's this concept of we are consuming more residential space than we did pre-COVID. I think.
Got it.
There's not as many shares as there were pre-COVID. There's, probably, if you were in a studio, you probably have a one-bedroom now because your economic situation is better than pre-COVID. And the strength of the employee through COVID, when, banks were giving out these huge raises, $100,000 salary to a starting, investment banker, that had a lot of impact, and you could consume more space.
We have 3 young couples in this office that live or are getting 2 bedrooms. When I first got married, I lived in a small 1-bedroom that you could call a studio in the West Village. Well, these are newly married couples that aren't even considering a 1; they're going to a 2. That was not happening before COVID. So you're absolutely right there, and that's just 3 people in this office.
Good point.
So
think about it.
It just could
That's a
be
very good point. I was in the same boat as you.
Boom.
Yeah.
I never went beyond a 1 bed until I had a kid.
Look at where you lived in 9th Street with your wife. That was a small. I lived in the same thing. Small 1-bedroom.
Small 1 bed. I
in
loved
the village.
it. I
Yeah,
loved it.
Same.
Once
But
we had a kid,
that
we
doesn't
got more
fly
space.
anymore with these people. No.
It's the first time that I've considered this concept.
Yeah. People without kids living in 2 bedrooms.
just that we're using more. That people
Yeah, they are.
paying for more space.
They are. It's definitely true.
Yeah, so that's one thought about the vacancy rate.
Yeah.
Can we talk real quick about the bond market and the stock market and the real estate market and interest rates and values?
Derek, you don't want to tire your listeners with that negative information.
Do you think the listeners have made it this far?
Yeah, that's a good question. Well, I guess in the case that they're no longer with us, we should certainly talk about it now. It's a really tough situation. Cap rates and real estate as an investment class is about capital flows, and real estate as an asset class benefited from very strong capital flows for the past 15 years. That was because the bond market had no yield. The equity market had very little yield. And that made the yield in real estate very compelling, which drove down cap rates just because of the risk associated with that asset class and how it was perceived. And I mean, right now we could have a fundamental change in capital flows. We don't really know where all this stabilizes, and a lot of that I think is driven by the bond market, which is providing yields that I've never seen before. Just like in my office, we would have never ever in our entire lives spoken about investing in a treasury bond, but now it pays in the short term 5%. That's kind of amazing. So I think a lot of institutional capital can utilize bonds to match their capital needs. Like if it's a pension fund, they can match their future obligations with bonds right now. And I think that is going to potentially lead to a change in maybe where capital flows go. And if that money first goes to bonds, because they're attractive right now, then they'll go to equities, and then they'll come to real estate.
Yeah.
But real estate will probably have to adjust.
If you get 5% in bonds right now, what does it say about real estate when you have to manage tenants and people and things breaking?
Yeah,
That's
absolutely.
bad.
When you say we're in my office talking about investing in treasuries, is that as the company, or are you guys talking about
Oh no, sorry. So no, individuals.
Yeah,
Sorry.
Yeah. No, I get it. I just wasn't sure.
No, but
Locker room.
my associate or analyst will talk about it. Investing in treasuries right now for the first time. I mean, that just would
100%.
never be an investable universe.
For sure. So, all right. So let's just. I don't know where you can buy a treasury. Like, what is it? You buy a 1-year treasury, or like how does it work? 5-year?
I'll do some marketing for treasurydirect.gov. It's
Okay.
a federal site that has vastly changed over the past several months because the government, I don't think, expected so many private investors to invest in treasuries. So it almost overwhelmed this website, but it's the most primitive looking website you've ever seen. That is the portal for to buy government bonds. It's very actually interesting.
But what are they trading for, and how long duration is your money tied up for?
Oh, I mean, whatever duration you want. I mean, it's actually, I can't even believe I know about this, but it's, so you can buy a 6-month bond. The auction is like every 2 weeks. You can buy 12-month, 2-year, whatever it is that you want. The yield curve is all above 4% right now, which is, never happens, and it's just whatever you want to do. The thing about it, from my perspective, I was probably a lot more bullish on this a couple months ago, but now my Merrill Lynch account will provide 4.25%, 4.5%. So
Savings?
It's amazing how much those accounts have increased. So
I was saying Amex now offers that too, high interest yield accounts.
yeah.
A lot of different places.
Bank of
to
America
park
definitely does not.
Dude, Bank of America's offering 3% cash back on the credit card.
Yeah, I mean, that's pretty good.
Bank of America owns Merrill.
Yeah, okay. Well, why do we...
All right, so I guess what I'm trying to get to, I'm going to send you a deal, okay? I'm going to send you a 421A deal or some free market deal. Maybe there's some value add play.
Please send several.
Yeah.
But and maybe this isn't something you're comfortable getting into, and we could always cut this, but what kind of yields, what kind of cap rates are you pricing in, or where's the market pricing in these deals? Are we still at 5s, 5.5, 6s, and how does that relate to the treasuries? And are we at risk of still paying too much for real estate if treasuries and bonds are where they are right now?
Absolutely. I mean, because where interest rates stabilize is the $1 million question. I think the Fed last indicated that we should expect elevated rates through the end of 2024. That's pretty amazing. And then what would actually cause a decrease in interest rates? Something really big has to happen, for the Fed to drop rates. And right now, it doesn't seem like that will happen, but we have some real risks in the system, particularly related to our banks, and we'll see how that plays out. But the amount of defaults and foreclosures in the office world, blows my mind. And everyone's exposed to office. I mean, it's really remarkable. My company's not, so I actually can't talk about this stuff too well, but like even the high net worth, like multi-generational, like New York City real estate owner, they have a lot of office exposure, and it's really a huge issue. I mean, like if you looked at it in terms of the REITs, the implied cap rate, I think, of REITs right now is like 6.5%. You know, like these guys need like 4.5%. You know, the spread is very substantial right now. And it's going to lead to a lot of problems.
Do you think 6.5% is still too low?
Yeah, because I think, unfortunately, there's a binary event where we're getting to yields that are below the debt. You know, like a lot of the reason that not much traded in the fourth quarter is because there's a natural floor of when something's going to actually trade, and that's the debt level. And when you talk about these types of cap rates, you're getting to below the debt, so these things can't trade.
They can't, yeah.
Well, you know who's going to trade them are the banks, and that's when cap rates will really, you know, accelerate downward for particularly office.
And with all the vacancy in office, how do we even know what those cap rates are, right?
Yeah, I mean, I think we're still trying to figure out the long-term use of office in today's environment. So yeah, it's a real question. But I personally cannot imagine that we do not come back to the office. It is too valuable to be sitting in a room with each other and talking. It's too valuable to be with all the different employees that I work with and coworkers to talk to them and, you know, help me understand what's going on, for me to help them, you know, learn from whatever I know. Like, it's too valuable.
So valuable.
My wife just went back to 4 days a week, which is big. She's at a hedge fund, but that she likes it. I mean, it needs to happen. And obviously, I've been in this office since July of 2020. But like,
for sure.
I couldn't imagine sitting in my house just like. There should be distractions. It's not fun. Like, we talk to each other all day. What we're doing today, right now.
The only problem with that thought is that we are all urban livers. We can't afford to have the nice, you know, home office that the suburban. Like, you know, working from home is
smells of like mahogany. Like, that does not happen.
Yeah, looking out at your garden with the big like window.
Yeah, all the books.
Your books.
Yeah, come on.
Work from home is a suburban concept in my mind.
Correct.
It is, you know, really remarkable. And
it's a good point.
But, you know, in a soft labor market, I've got to imagine that suburban workers are more incentivized to come back in. But
yes.
I don't know. I live in Park Slope, and I'm shocked at, like, my entire, like, subset of the neighborhood. Like, I feel like everyone's still working from home.
Like, in the coffee shops are just booked, like, all that?
I think they're, like, working in their units, in their apartments,
That's
in their houses,
You're
whatever
staring
it is.
at a white wall all day?
I
It's
mean, I don't know if
depressing.
they're staring at a white wall, but they're
What are they
not
doing?
going into the office.
They're not getting dressed. That's what they're not
No,
doing.
they're definitely not getting
Which
dressed.
is also a
I
problem.
I walk my kid to school. I'm the only one dressed.
That's unbelievable.
I mean, it's like slowly you're starting to see people, you know, getting dressed for work, but it's not much.
It's not good.
All right, I think this has been good. I think
Yeah.
we got into some interesting things. I had one last question, Jesse. This was posed to me by a developer in Brooklyn who's got a lot of stuff. He's always just thinking about stuff, and I thought it was applicable to this conversation. So he asked, you know, for values of his real estate or value of your portfolio, you guys are long-term holders. What would you rather see? An environment with low inflation and low interest rates, so basically an environment that we had a few years ago, or would you rather see high inflation, which, you know, some people say real estate's a great hedge against inflation, just have high inflation and high rates? Like, what are your thoughts on high inflation, high rates, like maybe like where we're at today, versus low inflation, low rates a couple years ago?
I don't want high inflation. I think it's horrible.
Okay.
You know, I haven't purchased a new car in several years because of inflation. I mean, it's really, really difficult to evaluate and predict things in an inflationary environment. I think it's horrible. I'd much rather have low interest rates and low inflation, but you know, the interest rate thing are the two required. You know, we don't. Inflation is so unpredictable. We had such a period of low inflation that I could give you so many different reasons for why that potentially occurred, and no one knows. Like, is that repeatable? I don't think so. You know,
Really?
like it really was remarkable. We're doing so many things that will cause permanent inflation in our country. Just, you know, bringing back manufacturing, you know, from China. Like, the isolation that's going on globally is going to, you know, really wreak havoc on inflation. Like, there's just certain things that we're not going back to 2%. And, if you just think about like the tech companies and sort of what was going on in our environment, or like Amazon is such a great example. Amazon all of a sudden brought like low-cost goods into our households, right? It lowered our cost of living like Walmart did when it expanded in the 80s. It lowered the cost of living. Now, potentially made our lives better. I mean, it remains to be seen if, fake goods off of Amazon make our lives better. But that was done on the backs of a nonprofit. Like, think about Amazon coming out of COVID last year, 2022, and not making a profit. Like, how does our largest e-commerce company not make a profit? Now, they have operated like that for years, causing low inflation because they provide us low-cost goods. And they didn't make money. It was not sustainable. It's not a sustainable way to live. Just think about, extrapolate that to whatever business. And we were doing that on the backs of low cost of capital. And we could do so many things, but we don't care about profits because we are just so focused on growth. That alone could have caused a low inflationary environment because it wasn't sustainable. It wasn't profitable. So, where we go with inflation, I don't know. And, we can see some of the challenges it caused by having, low cost of capital. I mean, we almost had driverless cars in the backs of, low cost of capital. Like, it's very interesting. So I don't know.
All right, cool.
Really appreciate the conversation.
Anything else you'd like to add, or
No, I think I've said my 2 cents.
Zach? Anything?
No, it was a great conversation.
Yeah.
Luke?
Enjoyed
No,
being
it was,
here.
it was really, really eye-opening.
Yeah,
It was a good conversation.
Really good. So
Yeah.
we'll wrap
Pro-
it there.
Yeah, probably one of the highly educated real estate investors we talked to. So it's
Incredibly
good.
well educated.
They don't really come like that anymore. So that's
Man,
good.
I'd love to have access to his data sets.
Yeah. Well, thank you, gentlemen. It was really a pleasure.
All right.
Yeah, all right. Thanks so much, Jesse.
All right.